Good morning. Welcome to Market Monday for February 3rd, 2025. Already in February, just like that. Last week, the Fed held its first meeting of the year where they held rates steady. A pause. Was a pause disappointing? Don't we want lower rates? And don't we want them now? Not so fast. A few months ago, we looked at fast versus slow cutting cycles. Have a look. Here, cutting cycles are classified as fast if there are 5 or more 0.25% cuts or 1.25% total cuts in 1 year. Slow has less than 5 cuts in a year. And in green, are one and done cutting cycles. It appears on average, fast cutting cycles tend to feature drawdowns that are double slow cycles 6 months out, and triple the drawdown of slow cycles looking 12 months out. So we really shouldn't fear a pause, and in fact, we should welcome it. Here are the soft landing cutting cycles of the 7 most developed countries, the so-called G7. Anytime the line is moving horizontally to the right, that's a pause. Clearly, plenty of pauses during soft landing cutting cycles. And here we're looking at the number of times how many pauses of at least 3 months occurred during soft landing cycles. So we see here there were 3 pauses, each lasting more than 3 months here, 2 pauses of at least 3 months here, and so forth. So in and of itself, definitely not reason for concern. Well, January is now in the history books, finishing in the green, up about 3% for the month. Does it matter? When January is higher, the average return for the rest of the year has been up 12.2% compared to just 2.1% when January is negative, with a hit rate, meaning how often is the rest of the year positive, of 86.7% compared to just 60% when January is lower. So looking at this frame alone, it does appear a positive January tends to bode well for the remainder of the year, historically speaking. Here's another look. Here's the average of years in the S&P 500 stock market since 1950, with a positive January here in orange and negative Januaries here. These are averages, and we always want to be careful of extrapolating averages, but at the same time, we want to be aware of what history is telling us. Did you hear? There was a buyout offer for all 2 million federal workers, offering an 8-month deferred leave where they would receive full pay and benefits with no expectation to work. Clearly, some will take it. Some are talking about 10% of the workforce. If 10% were to take it and none of them find employment elsewhere, the unemployment rate would increase by 200,000. Here's the total number of jobs here in white. Here's the private sector. And you have to look way down here to see the total government employees, excluding the Postal Service. So reducing this by 10% would only increase the unemployment rate by about 0.1%. And today we'll leave you with self-driving taxi company Waymo picked up close to 500,000 passengers in California in August, up from fewer than just 20,000 a year earlier. Have a great week.